Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Namaskar, my name is Shishir, and today we are going to talk about macroeconomy, how the things are shaping up. There are a number of high-frequency economic indicators which were made public during last 2 to 3 days, and every number is showing good progress, except some kind of concern on the GST. What trend we can observe from this number, and what is the outlook, and especially on inflation? The another high frequency economic indicator, which will be out on 12th of this month. To talk about all those things, we have with us Achala Jethmalani. She is an economist with RBL Bank. Achala, welcome to the show.
Hello, everybody, and thank you, Mr. Shishir, for having me on your podcast. It's indeed a privilege. So, as you rightly mentioned, yes, there are some mixed trends that we are observing. And when you talk about the GST collection, so to speak, of course, on a growth rate basis, we've seen the momentum take a backseat. The rate of change, if you see for the June print that we are looking at, is 7.7%. But in absolute terms, there is still a lot of comfort one can draw with the numbers still coming in at 1.7 lakh crore kind of trajectory, right? So that way it is not as concerning in terms of tax mop-up per se, given that we were also in the election phase. It could be possible that some activity must have slowed down to an extent, which probably is getting reflected in the numbers.
Okay. Achala, now coming to another number, which is the PMI manufacturing. What we observed that in the month of June, it has recovered from May. And most important thing is that there were more and more job creations. How do you read this PMI manufacturing number?
The number, when you look at the trend rate, we have still been close to the 60 levels per se. When we look at the top 10 to 12 countries table in terms of PMI manufacturing, we observe that India still tops the chart when it comes to PMI manufacturing. It is moving in sync with a loss of momentum as is being observed for some of the global economies. But at 58.3, with sub-indices such as new orders, export orders, picking up, is also in a way reflecting that at least next couple of months we could be looking at a positive trajectory when it comes to manufacturing space. Also, when we look at the new investments that were announced, one of the CMI indicators that we closely track, it actually dipped in the quarter of June, and it can get attributed to the election phase that we were into. So now that is behind us. We should see the momentum go back to what it was at least pre-election period. And if at all the budget comes up with some more support schemes or something that's more conducive for, say, manufacturing space overall, then we would be looking at a much more upbeat sector performance overall.
Okay. Asla, one thing which is very heartening to note, that is the more and more job creation. That is one of the most important issue at this moment, whether we talk about the political discussion or whether we talk about the economic discussion. How do you read the number? I mean, is it just a short-term filling the post, or you are observing a long-term trend in the job creation?
Actually, employment indicators, we just have certain proxies to go by. So it's very hard to determine what is the trend looking like. But for example, when we look at, say, NREGA employment, that has come down dramatically for the months of May and June. On a year-on-year basis, the number of person days employed has actually gone down by about 57-58% on a year-on-year basis. But when we look at the CMI unemployment rate for the month of June, that figure is up at about 9.2%. In the last 2 months also, it was at 7 and 8% kind of levels. So it is very hard to gauge whether employment situation for the country is improving. And yes, it's one of the most pressing issues that India is currently facing. One is, of course, you don't have data to go by. And the second, when you look at some of these proxy indicators, not all indicators are moving in sync, which can then say that, jobs are being created, and now labor is getting absorbed in certain sectors. A lot of times, it's hard to differentiate between seasonal employment and permanent employment. That also is one of the challenges that it needs to be addressed in order to understand what is the employment trend in the country.
Okay. And when I was reading the PMI number, one thing which I noticed about the producer inflation, or what we call as the wholesale price index, they are saying that the prices have gone up, the input cost has gone up, the pay bill has gone up, and they have passed it on to the end consumer. And that is also reflected in WPI. So how do you read the price factor, especially when we talk about manufacturing?
Yes, so when we are looking at commodity prices globally as well, and when we look at WPI, manufacturing products inflation did actually go up. So to an extent, it's also driven by the global commodity price spike up that we are witnessing. And input cost inflation could be an area of concern if commodity prices were to stay where they currently are. But the expectation is that if China slowdown was to persist, then the current levels of commodity prices that we are seeing may not sustain. So as of now, it appears to be a transient phenomena where we are seeing sharp spike in some of the input costs in certain categories. It's not broad based. It's specific to certain components and categories.
Okay. Now coming to the fiscal deficit number, the first 2-month number shows that it has come down to 3% of the budget estimate, which is, I believe, after almost a gap of 22 months, we are seeing a monthly surplus in the month of May. Is it just because of RBI number, or do you see that the tax numbers are really giving good growth?
So this time's numbers are very interesting for two reasons. One is there has been a slowdown in spending because we were in the election phase. For example, CapEx spending for the month of May was down by about 50%. So for the first 2 months, it contracted by about 14.5%. Add to that, there was a robust tax collection. So for the first 2 months, we saw about a 38% jump in overall revenue receipts. Of course, one of the major reasons was the RBI dividend, as you rightly mentioned. But it is not just that; it was also tax revenue collections, which were up about 14.7% on a year-on-year basis. So as percent of budget estimates, we are already at 12% when it comes to tax revenue. When it comes to dividend, as percent of budget estimates, as you know, RBI dividend was almost 2 times of what the government had budgeted for, right? So that's another reason why we have seen the fiscal deficit narrow down so much and turn into a surplus for the first 2 months of FY25 and May, basically. May particularly, the 2-month deficit is a marginal 500 billion kind of a figure, but may turn into a surplus largely because of these twofold factors playing out both on revenue front as well as on capital expenditure spending front, which took a backseat as we were right in the middle of the election phase.
Okay. Now, everybody is looking for some kind of revision of fiscal deficit when the full budget will be presented later this month. What is your expectation?
On the headline front, we are expecting the fiscal consolidation to continue, a fiscal deficit figure of close to 18 lakh crore, similar to what the interim budget has budgeted for, is what we are continuing to factor in. And in terms of reallocation within ministries is something that we will be watching out for. So fiscal consolidation roadmap is unlikely to be compromised. Second, on the capital expenditure front, we continue to assume that 11 lakh crore kind of spending is what the government will budget for. It will not neither increase it nor decrease it. One of the other reasons is the government will have about only 8 to 9 months to spend that much money, with capex spending already taking a hit in the month of May. For it to come back and rebound by that much would also probably take some more weeks and probably a couple of months to come back to the system. So therefore, on the headline front, we think that, of course, the concerns are quite valid, given how, say, some of the state budgets have been of late, with Maharashtra budget being the latest, although it remains well within the FRBM Act of budget deficit of about 2.7 to 3%. But when you look at the revenue and capital expenditure mix, and with the welfare tilt that we have seen, it is very valid for someone to expect that fiscal consolidation could be compromised. But we are a little optimistic on two counts. One being the RBI's dividend, which will give the government the elbow room of about 0.3% of GDP to accommodate for its additional expenditure, if at all it is planning. And second, without having to rely on market loans, it can continue with its capital spending plans that it laid out in the interim budget.
Okay. Now, the next high-frequency economic indicator is the retail inflation, the number which will be out on 12th of this month. What is your take on that?
Yes, I think for the month of June, the number will be quite similar to 4.6, 4.7 kind of figures that we saw in the month of May. The previous print was 4.75. June will be running close to 4.6, quite similar, because vegetables inflation has not given much respite so far. And it will be largely because of an 8% kind of food inflation trajectory that we are continuing to witness. In the previous month, sub-index, which is the Consumer Food Price Index, CFPI, was at 8.7%. And for June, we are saying it will still be at 8% kind of a reading. So even with core inflation coming down to 3%, the medium-term target of 4% is still at least a month away, because for the month of July and even till September, we will be seeing a CPI inflation print of about 3.5 to 3.8%. Only in September would it go back to, say, 4 to 4.5% kind of a figure, depending on how the monsoon pans out, whether there will be a correction in vegetable prices, and how will the telecom tariff hikes translate into your slightly higher core inflation than what was being envisaged. So some of these moving parts are still there, which in a way brings me to say monsoon. For the first month, we've seen that the rainfall deficiency was about 11%, and we have July and August. There's a lot of literature out there which indicates that why July and August become crucial for kharif sowing, especially for paddy crops. Given that cereals inflation has been running high at about 8 to 9%, it would be important to see that food grain prices start ticking lower in order to get to the 4% kind of inflation print that we want to achieve on a durable basis per se.
Okay. Achala, thank you very much for talking to us.